In this video, we're going to take a look at one of my favorite trading setups. It's a mix of the golden pocket and a V-shape. Essentially, the golden pocket is a Fibonacci retracement between the 50% and the 61.8% levels. The 61.8% level, of course, being the golden ratio, and a level that a lot of traders take a look at. Furthermore, the 50% Fibonacci retracement level, which ironically enough is not actually a Fibonacci number, is an old throwback from the Wall Street trading days in the early years, where traders would just simply wait for a move to pull back about 50% before trying to find value. One of the biggest problems with trading Fibonacci retracements is that most traders jump in as soon as they're hit. The problem, of course, is it's quite common to see the 38.2% Fibonacci retracement level offer a reaction. The 50%, which of course is not a Fibonacci number, or the 61.8%, and you don't really know which one to take. Beyond that, sometimes price action just slices through all of them, and therefore Fibonacci becomes somewhat useless. So what I look for is a combination of that and a reaction. When I get both of them, then I start to take the trade. There are some other conditions that I will talk about in this video as well, but I have found this as a way to be a little bit more patient and save myself some unnecessary losses. In front of you, I have a NASDAQ 100 daily chart zoomed out quite a bit to show signs of these massive pullbacks that hopefully you'll learn to take advantage of. By putting a Fibonacci retracement on this chart, you can see that the market had hit the 50% Fibonacci retracement level from the swing high. Now, most traders, and in this case, you probably would have been okay, will just simply jump in here. But what I like to do is I like to see this V pattern play itself out. In other words, I like to have the market prove itself to me. It's a simple 3-bar reversal. Notice that we have a negative candle here, a negative, but then a turnaround candle here, and then we break higher. So it's low, a little lower, a bit higher. That is a classic example of momentum shifting in your favor. Once you get the momentum in your favor, then it's just following the trend. That's pretty straightforward. As a general rule, I think the first target is almost always the swing high. That is commonly what you'll see have happen. But another thing about this is that the low point in an uptrend of the 3 candles then becomes your stop loss. Proper risk management means that you won't lose much if it does turn around for whatever reason. Remember, not everything works 100% of the time. But as you see on this chart, for the 1 that you would have risked for every $1, you gained about 2.5 just aiming for the swing high by itself. So having said that, it is a little bit of an ideal setup. Let's go ahead and take a look at an example that, quite frankly, hasn't worked out, at least at this point. So as we go through and we see that latest surge higher from about the middle of April to the highs all the way in July of 2024, we had another pullback in the Fibonacci retracement level to the 50% range and even down to the 61% range. Well, notice that right here, you did have the negative candlestick, but you really didn't have a V. You had an impulsive move to the upside, and then you wiped this out. So even if you did take this trade, you clearly should have been stopped out by here. You should not be hanging on to it and becoming a bag holder. This also works in downtrends because the most important part of this simple trading system is it's following an impulsive move. It's offering value, but more importantly than anything else, it offers a stop loss. If you break the bottom, or in the case of a downtrend, the top of a V-shaped pattern, it's time to get out. In this drop on the 30-minute chart of the Nikkei 225, you can see that we plunged in late September, dropping from 24,500 yen down to 20,814 yen before snapping back to the upside. You'll notice that we ended up forming a bit of a shooting star that poked into the 50% level between that and 61.8. We did, in fact, get a massive V pattern. Your stop loss would go on the chart just a couple ticks above the top of that V pattern, and you would be aiming at the very least for a move down to the previous swing low. And in this case, you actually got quite a bit more. That's not uncommon. That happens quite a bit, but I would postulate that you at least want to see a continuation of the overall move. During the early part of July in 2024, we saw the crude oil market struggle, and on the 4-hour chart, you can see that there was quite a bit of choppy action. Notice as we topped out near the $83.75 level, forming a double top, we also started to fall and then got a wicked snapback. We ended up forming a 3-bar V pattern right below the 61.8% Fibonacci retracement level. So we had entered that golden pocket, as it were. And once we broke down below the third candlestick, we really just took off. We got back down to the original move, never threatened the stop loss. And even if you hung on to the trade for a much bigger move, the retracement still wouldn't have put you in the red for very long. You'll notice that the next move looked very much the same from the original fall. And then if you take when we accelerated, it looked very much the same as well. We peaked just above the 50% Fibonacci retracement level and then just fell apart. This was not as impressive of a 3-bar pattern, but it is there if you look. The point of this system is you are waiting for not only the right level, but what you are waiting for is for the market to confirm that there is a reaction. Of course, you can get whipsawed, and there's really nothing to do about that other than to place your stop losses. But quite frankly, this is one of the most simple and systematic ways I have found to trade. And in fact, it even works on ultra short-term charts, such as the 5-minute chart, although again, it's a short-term chart, so you do have to realize that it tends to be a bit noisier. But here's an example of a 3-bar play on the 5-minute chart in crude oil as it fell apart. You could also go looking for a much bigger move from the next swing high as we broke into the 50% retracement level and then fell to reach the original move to the downside after forming a couple of shooting stars in what would have been a messy but visible V pattern. Ironically, on the recovery, you do see a situation that could get you into trouble. And the reason I want to point this out to you is because you could make an argument that this was a setup, except notice how the initial surge lower was a much bigger candlestick than the stabilization candlestick. And then the candlestick after that wasn't exactly overly bullish either. And in fact, we hadn't taken out the top of the original candlestick to form what would have been the left-hand part of the V shape. So in other words, the fact that it took multiple candles to even approach the top of that candlestick tells you that you could have been in trouble, as there really wasn't a lot in the way of momentum, and it did in fact end up selling off. The beauty of this, of course, is that even if you made that mistake, your stop loss still would have gotten you out with a relatively small loss. Remember, traders, the key to success is to lose less.